Good morning, everyone. Welcome to S&R Markets. Thanks for joining us. Great that you're here. We're going to take a look at how to trade support and resistance strategies. So first of all, of course, we'll be taking a look at what is support and resistance, what kind of tools can we use to identify support and resistance, and then how can we use that basically those tools to trade the levels as well. So that's coming up. Well, first of all, though, be aware that this webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out if it is suitable for you. Also, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. So Nenad shared his support and resistance views 2 weeks ago. I'm going to do that today. And basically, the goal for, probably as Nenad also discussed already, but once again, just to make sure, is basically finding support and resistance, spotting specifically the POC zones. And POC stands for basically points of confluence, and S&R, of course, stands for support and resistance. Those are the terms that will be used often. I also use decision zones, which is just a different word basically for POC zones. But there's a slight difference. POC zones are basically multiple support and resistance levels, all right? So they basically give confluence. That's why we call them points of confluence. So although we could find one support or resistance level, it might not be that significant. It might not be that important, right? But if you find a bunch of them together, then we call them POC zones because the more support or the more resistance, the more likelihood that there's that zone or level will have an impact on the market. So finding support and resistance is one thing. Spotting a POC zone is a different aspect, right? We want to see multiple levels. Now, what's the difference between POC zone and decision zone? Basically, decision zone is an area where I expect a price to make a decision. It's a maybe a more important zone than POC zone in some ways. It also could literally be just one level that is really key, very critical. So we'll discuss that later on. I just want to make the terms clear. So POC zone and decision zones are roughly the same in this regard, with the maybe slight kind of distinction that decision zones are really key, very critical to what's going on the chart. And then, of course, last but definitely not least, is how to use support or resistance to trade, right? Trading breaks and bounces, etc. Because basically, support and resistance levels, there are many of them out there. And I think there are quite a decent amount of strategies based on support or resistance. But I do think that if you just trade them without a larger context, there could be a bit dangerous, or they could have short-term kind of viability, but in the long term, maybe go through pretty steep drawdowns. And that's because of the fact that although there is a support and resistance level available, everyone can see that, or most of us can see that once you do a little bit of practice and a little bit of experience, we would quickly see that. But how do you trade it, right? The support or resistance does not necessarily say how to trade it. Price could break, price could bounce. How do you know that, right? How do you use that support or resistance? That's a main question that simple support or resistance strategies really don't go into. They might be looking for reversal setups, right, at a resistance level. But will price really bounce at that resistance? We don't know, right? So support or resistance, that's something you want to think about. It is only part of the market structure. I will explain that a little bit more in a second. We'll take a look at live charts, by the way, not so long from now, but I just want to explain, first of all, what are the support or resistance tools that you can think about. There are many more than this, but just to give you an idea, there are three groups basically: static, S&R levels, semi-dynamic, and dynamic. So it's not that complicated. Static are levels that are just going horizontal, tops and bottoms, fibs, round levels, they don't change, right? A 130 psychological round level stays 130. It doesn't become 140 all of a sudden. I mean, it's 130. 140 is important too, but because it's 140, right? It doesn't change. That's my point. Semi-dynamic are, for instance, trend lines. They do move, right? They move with an up angle or a down angle, but they move at a steady rate, right? Price does not really influence the angle of the trend line in the future, at least, right? So dynamic is different, and you will understand the difference between semi-dynamic and dynamic when I explain dynamic. Dynamic is moving average. So every candle that you see will impact how the moving average looks like at the candle close. Keltner indicator 2. So that's a dynamic, clearly dynamic. It moves along with price. Now, semi-dynamic is different because the trend line doesn't change just based on the newest indicator, right? It stays the same. You could change the trend line, of course, but that's why it's not dynamic. You need to change it yourself. So as I already was referring to at the beginning here, support and resistance is part of a triangle that I consider to be market structure. So when I talk about market structure, I really talk about three things, right? Support and resistance, trend and impulse, and price patterns. When analyzing these three things, I understand what is the market structure and how I'm able to trade it. That's a bit more complex analysis than just looking for pin bars at a pivot point. Although that system with maybe some extra rules might work okay for some traders out there, I'm not saying. It is, as I said, I think we'll run into some problems when the market dynamics change. All right, just giving you a heads up here. By using these three things, I think you're more, in control or in a way more understanding the chart in front of you. Right, you're using all of its aspects to your benefit, in my view. Support and resistance is an important part of that equation. Although in my view, price patterns are the most important, but support and resistance is a key part. So let's move on and finding support and resistance. How do we find it? And how do we find those POC zones? So I'm going to show you a chart after this slide. Basically, things I do. This is what I do. Now, this is not the only method. Maybe not the best method necessarily either. Maybe there's someone out there who uses support and resistance in a faster way. I don't know. Of course, there are many traders, many analysts out there. Who knows? But this is my method. I use fibs on a swing. I use tops and bottoms, 2 moving averages in my live webinars, a bit more for myself, but that's because I don't want to crowd and over kind of I don't want to make a chart that looks too messy or too complicated, right? So I keep it simple for the audience. Trend lines and ad markets pivot points. Those are the most used support and resistance tools I use. And together, I kind of find the zones, decision zones, and POC zones based on those 6 things. All right, so let's take a look. You will take a look at the live chart now, but basically, those are my main criteria. I think it depends also when and where I use it. Does depend on my trading plan. I will use these things at different spots, by the way. So, for instance, the moving averages are great for identifying the trend, but they're also good for identifying support and resistance levels on lower time frames, right? Moving averages are better for trend definitions on higher time frames. Pivot points are great for intraday trading, for instance, right? Tops and bottoms are great for daily charts, in my view. Highs and lows are great for daily charts too. Fibs can be used on all time frames. Trend lines are great for hourly charts. So, it does depend a little bit from that point of view. But generally speaking, I use these concepts. So let's take a look. All right. So let's see. Let's start with a blank chart because I have some things on this, which let's start from the very beginning. All right, and let's take a look at a hypothetical example first of all. All right, so back here, I know we're going back a little bit beginning of this year, but just to give you an example, right? There we go. So price is in a downside. So, oh, sorry, looks like I used the wrong. Oh, there we go. I wasn't sharing my chart yet. There we go. All right, so now you see the chart. So price is in a downtrend, right? So that's important because for the fib, we want to put the fib on the swing high, swing low. That makes the most sense with the trend. If it's a range, we don't even have to use the fib. So in this case, we see that price is retracing to the 50 fib, right? So that alone is a decision zone, just based on the 50 fib, is enough for me. So some levels, we don't need necessarily confluence, and they could still be important, by the way. Sometimes a level becomes important because there are multiple supportive resistance levels in that area. Now, besides that particular 50 fib, there is a moving average, though. There is a previous stop. So there are a couple of things, indeed, that support the 50 fib as well. And indeed, as you can see, price turning back down. So first of all, let's note the principle how supportive resistance works. As you can see, in this case, price tested that level, didn't manage to break above it, and it, in fact, reversed or bounced, right, at that level for more downside. Right, so that's how the 50 fib worked. Now, if you look carefully, the 38.2 fib, in fact, also was respected right here. You see, 2-3 days that didn't break through that level. It's maybe not as visible as the 50 fib because the 50 fib, of course, we saw a big reaction to that level, didn't we? So let's zoom in a bit to that. All right, so you see the big 50 fib reaction, but look at that, the 38 as well. All right, so not every reaction, not every bounce will be the same at support or resistance. And that's something I already mentioned before. If you only look at support or resistance, it's sometimes difficult to know what kind of reaction you'll get. Will there be a big bounce, a reversal, a small bounce, or a breakout, right? And that patterns basically help us identify what is more likely. Candlestick patterns, for instance, are very important. That's something we'll discuss when trading breakouts. That's something for later, though. In general, note the fact that the 38.2 fib was respected, right? Price bounced at it a little bit, but then broke above it and continued up to the 50 fib. Then the 50 fib was respected. That created a bigger retracement, though, and eventually, however, price still continued higher, right? Above the 50, up to the 61.8 fib. Missed it by a little bit, but okay. Market isn't perfect. Respected the 61.8 fib, made a bounce there too, and then continued higher, and then eventually broke through all of these fibs, in fact, right? Actually stopped at 61.8 the second time, like this, and then eventually broke above this fib. So this fib eventually got broken, in a way. But despite the fact that the fib, in a way, proved to be not so useful because it wasn't a downtrend anymore, it was actually the start of the uptrend, it still proved to be useful in the sense that price respected the fib level still. Right? So, although fibs are a tad more difficult to know when to place it where, if you use a swing with momentum, even if it's not, even if the trend would change, it's still quite beneficial to use. Only when price is ranging, it's not so useful. But the fib is just one tool, right? Round levels, tops and bottoms, daily highs and lows, weekly highs and lows, monthly highs and lows, moving averages, Keltner, all of these are things that can be used as support and resistance too. All right, so basically, how do we find a confluence zone? Well, we basically look for an area where we see kind of these multiple things come together. So let's see if we can move maybe a little bit more to the future. And we could use, for instance, let's take a look at this little part here. All right. So for instance, here we see that price actually is above the moving average, right? So it's indicating that it's an uptrend at this moment. And we could put a trend line like this to connect the bottoms. All right. And we could put basically trend lines like this to connect the tops. All right, like that. And we have a horizontal level right here. And we can put a fib probably from here to here, from the bottom to the top. Alrighty. So in this scenario, how could support or resistance help us? Well, basically, as price is moving down, right, we might think because of the uptrend, because of the support trend line, there's confluence of support, right? There's a fib, there's a bottom here, there's a trend line, there's Keltner, moving average. All of these things could provide support for a continuation to the upside. Now the trend line gets broken by a little bit, but it's important to note that horizontal levels still, provide levels as well, provide support as well. So you got to be careful with breaks against the trend. They might run out of steam soon, like it did here. In fact, it just bounced off the bottom and continued higher, right? So that's something to note and be careful of. But otherwise, you can see how, for instance, the 38 and this bottom played a role in a bounce. And two items only, maybe not that much, but maybe there was a weekly pivot point, for instance, which we don't see in retrospective because this is from the summer. Another way, of course, we can look at support and resistance is in the sense that this resistance trend line was broken right here, right? And we did indeed get the breakout to the upside. I should use blue for that. Sorry for the background sound. My cats are running around. They seem to be very interested in support and resistance. And so, this is basically support. Price uses this as support, but then also breaks this kind of bull flag pattern, right? And the resistance of the bull flag pattern for a break to the upside. All right, so that was a confluence at that 111 spot. We basically can find maybe one more example, and this euro dollar. Let me take a look. For instance, the Keltner, always useful. It's part of the MT4 Supreme Edition. Also the MT5 nowadays, by the way. And if you're interested in trying that out, the MT4 or MT5 Supreme Edition, just go to admiralmarkets.com, click on platforms, and feel free to try it out. All right, so that's something you can look at. Very good material there, 60 plus extra features. Besides all the things that the MetaTrader platform itself has, the Supreme Edition is something that Admiral Markets has built specifically for their traders, and a lot of extra tools. As I said, 60 plus, so you can check it out with regard to platforms. By the way, also tonight there's one more Masters of Trader, or I think two more left, Masters of Trader webinars. So check that out. It's tonight, so you still have time to register for that. But let's take a look at the Keltner. Basically, right here you can see price respecting the Keltner, not able to break through it. We can add a fib from here to here, like this, and we see that a bigger reversal might occur like this at the 61.8 fib and the Keltner, and indeed price goes up. All right, despite the downtrend at this moment, price makes a bigger upside. And in fact, one can argue already that price was, of course, making some bullish momentum here. So in any case, the Keltner and the fibs providing support for such a move. Plus, there's also a 105 round level, by the way, in this area, and it's a zone. Support and resistance levels, in my view, are a zone. So it depends on the time frame, but on the daily chart, 25 pips higher or lower it really doesn't matter too much, right? If there's a psychological 105 level, or in this case 105.25, that's close to 105. That's a confluence. Doesn't have to be exactly 105. Now on a 5-minute chart, that confluence might be closer than 25 pips, right? It should be maybe a few pips. On a weekly chart, it might be a bit more. It might be even 50 pips, right? It's a zone, not a level. Some traders really look specifically at a level. I don't think the market works like that. I don't think it's possible to be that precise. It's more a general area than a specific level, and at least that's how I use it. So 105, 61.8 fib, and the Keltner channel provide basically a confluence of support in this zone. So this is how you can identify, spot the support and resistance, and how you can find zones. Is that clear? Then we'll move on to how to trade it. So this is an important step, of course, but is in many ways something that most of you perhaps know, unless you maybe just started. Then these concepts might be new to you, but probably most of you know this. So if there are any questions, feel free to let us know. But otherwise, I'll move on to trading them. Of course, support and resistance basically has the opposite role if it's broken. By the way, I'll just add that for those that maybe are starting. So for instance, let's see if I can find an example. Let me try to get rid of this fib. There we go. So for instance, here there's broken resistance, and you can see that here it becomes support. Right? This is not a guarantee, nor does it always happen like this, but it is possible. It's something to think about. When price breaks through a level, that level has the opposite effect. All right, so now we're going to talk about trading support or resistance, how to do that, which is the next phase. This was just an introduction still. So basically, when price approaches the support or resistance level, let me get rid of these tools. All right, so basically, when price is making downside like this or upside like this, and it's approaching support on the left or resistance on the right, there are mainly, let's say, mainly two things it can do, but in reality, there are four things. To simplify it, price can bounce or break. So in the example of the bullish price action approaching resistance, a bullish break would be price pushing above that resistance, the blue arrow. A bearish bounce would be price respecting the resistance and moving down, the red arrow. With a bearish momentum approaching support, price would have a bullish bounce if it moves up, and there would be a bearish breakout if it moves down. So the breakout direction depends on whether you're looking at support or resistance. Obviously, if you're looking at resistance, it's a bullish breakout. If you're looking at support, it's a bearish breakout. And the bounce is just the same. Bullish bounce at support, bearish bounce at resistance. In practice, there are four reactions. Besides breakout and bounce, basically you have breakout, price moving sideways, price making a small retracement or big retracement, and price reversing. So there are substantial differences between price moving sideways, a medium or small retracement, or a reversal. Right? If price goes sideways, there's a good chance that price will continue later on with a breakout, but not right now. If there's a small retracement, same thing, price could tend to continue. A larger retracement is a question mark. It could actually expand its correction deeper, probably, or go more or less sideways still. A reversal indicates a total new trend direction or range. So there are pretty substantial differences in how price responds to a support or resistance level, as you can see. All right. One more thing, by the way, regarding support or resistance. Of course, these levels do not only occur when price is making momentum up or down, as I was just showing. They also, of course, are very important, or maybe even more important, when price is going sideways, right? A range like this, when price is going sideways, those support or resistance levels are well tested. Why? Because price is moving within these levels, right? So you have price moving up, price moving down, and the price is basically respecting roughly those zones. This is range, and support resistance very important within that structure too. So support resistance is always important whether the market is ranging or whether it's trending, as you can see. All right, that was a quick introduction about methods, or not methods to trade it, but basically what kind of potential trade setups are there really conceivable, right? What could we trade? Now we're going to dive into the details how to trade it, but before I do that, Andre has a question. How can I get those horizontal support lines? I'm using Admiral Market pivot points, but it's only showing current local dynamic support resistance levels, but not global as in your chart. Let's see. Well, basically, Admiral Market's pivot points would only show current levels like this. So these are the pivot points, right? And when I go back in the past, I don't have those pivot points levels either. All right. So here I don't have them, as you can see. And here I do have them. All right. Now you should see them eventually. I'm not sure if you see them now, but do you see these pivot points? I think now you should see them, right? So basically, I'm not sure if that answers your question, but so I also use Admiral Market pivot points, and those levels indeed only show current support and resistance level. The pivot point itself is basically a semi-dynamic one in my view. Why do I say semi? Because basically, yes, there are fixed levels for the day, but they do automatically update every day. So, from that point of view, it's kind of semi-dynamic. All right, so hopefully that answers the question. If not, let me know. Let's move over to trading support or resistance. The yellow ones, okay? Oh, you mean these trend lines? These green trend lines like this? Because I'm not sure which tool you're referring to, or the moving averages, perhaps. This orange one here. Horizontal lines. Honestly, I don't know which levels you're talking about because I don't see any. They're not visible now. Well, maybe I put a line like this, a purple line like this, but that's not yellow, so that doesn't make sense. This trend line like this, maybe. Hmm. I'm not sure which yellow one I was using. The Keltner is purple as well. So the colors. Oh, the fib. This fib, maybe. Horizontal static support resistance lines. Honestly, I don't know which ones those are. Besides the fibs, maybe. Is that one? Is that what you mean? Uh, yeah, this is a fib. So basically, you can basically click on this F, and then basically click on the F, find your starting spot, hold, find your end spot, release, and that's how you draw it. And you will have it will look different on your chart. That's because I add basically some levels on it. By going to Fibro properties, I add basically some levels. So you can look at the recording and look how I do it here. You see I have it shows here, you can look at the recording and see that I add a space, percentage sign, and dollar to get the price levels. and which levels I actually added, the 78 and 88.6 fib. We also have separate Fibonacci webinars as well, by the way. Fibonacci is quite a long topic, so I won't be able to cover that in the remaining 30 minutes. But Fibonacci is definitely worth investigating in the webinars that Nenad and I have done with Admiral Markets. Definitely recommend taking a look at Fibs. Very, very good webinars to learn more about that. Yes, exactly. Great. So trading support or resistance. All right, so we have the decision zones, right? We just did our homework, let's say. We did our analysis, right? But besides that, as I already indicated, you do want to kind of think about and understand maybe a bit more about patterns and what is the trend and impulse, just to get an idea about what price could do at the decision zone. Would you like to trade it there? Would you like to trade it up or down, and how? So it's something you want to think about to factor in. Once you've made that decision, whether you're looking for a break or bounce at support or resistance, and whether you're trading basically, or perhaps both, it does happen to me, maybe quite regularly actually, that a decision zone is available, and I just let market decide whether it's going to go up or down. I'm fine with trading both ways, right? In other cases, no, I don't want to trade it both ways. I'm only interested in one way, based on the patterns and the trend and impulse that I see. I only interested in trading it one way. So that depends. But basically, you do want to have then, after you did this analysis, an idea whether you want to look for a break, bounce, and how do you want to trade it. So there are two ways to trade it. One would be a pending order. That's something that Nenad actually does regularly, right? On his Monday recap videos, he's looking for retracements within the trend. He's using price action, patterns, and signals, and then establishes the trend and looks for retracements, looks for key levels, and puts pending orders there. So I'm a bit different trader. I use a market order, which is the second way you can go. So there are two ways, once again: pending orders and market orders to trade support or resistance. So if you use pending orders, you would basically place an entry right at the level that you expect, put the stop loss a certain amount of pips away, and place your target. If you are waiting for a reaction, a candlestick reaction, if you're waiting for a confirmation of price to respond to support or resistance levels, you will get typically a worse entry. But the benefit of that is that you have more confirmation that price is actually respecting your level. Because just because there's a confluence of support or resistance or any one particular support or resistance level doesn't necessarily mean that price will stop there. It's not a guarantee, right? So, but if you put a pending order there, you're taking that risk that price might not stop there, right? And if you wait for a reaction, if you wait for a confirmation of price at support or resistance, then you might get a worse price, but you have a little bit more. You have the advantage that you see a reaction, and if price doesn't react there, you're not in that trade, so you kind of avoid some losses with that. So from my point of view, for my trading, candlestick reactions are very important because that's my way of doing it. I don't trade support or resistance in such a direct way. I trade it with candlestick reactions, candlestick patterns. So what I'm waiting for are not only patterns, but the reaction of the candlestick itself to that support or resistance levels. So what is this slide about? What you see here basically is simply about the candlestick that is approaching support or resistance. So if we see a bullish candlestick, basically, if this is a bullish candlestick, right, like this, the green circle, and it's approaching resistance, right, like that. The candle will give us some information whether a break or bounce will occur, or it will give us a heads up. It's never a guarantee, but there's a good chance, right? A higher chance that price will bounce or break depending on how the candles react to that support or resistance. And why is that? Why would that be the case? Well, because basically in that candle, we can see kind of this, maybe in a way, the psychology of the market as it approaches that level. It's kind of like it's like a judge. It gives us a bit of an idea what the market is intending or thinking about doing. You know, and ZT is asking, is it 1 hour or 15 minutes? Basically, the market is fractal of nature, so really this concept is valid for all time frames. Now, of course, if you look at lower time frames, there's just a question of spreads that come into account. Now, Admiral Markets has low spreads, so that's the advantage. But of course, if you're targeting, if you have a 2-pip target because you're using a 1-minute chart, even a small spread is still a big part of that profit, right? So although the market is fractal of nature, some time frames or very small movements are really not that interesting to trade, right? But ultimately, it doesn't really matter. This principle of the candle reaction at support or resistance levels is indeed valid for all time frames. So when I look at how do I measure, this is basically this slide, and I will take a look at the live charts again. This slide is all about the measurement of the candle that is approaching or at support or resistance, or breaking it. So it doesn't matter if the candle is 50 pips away from the support or resistance. That candle doesn't matter, right? It's not about that candle. It's about the candle that is at the support or resistance level or breaking through it. A candle that has moved away from it already is also not important, right? All right, so probably very logical for most of you, but for new traders, it's important to realize what candle we're looking at. We'll look at live examples in just a second. But first of all, this slide. So we're looking at the candle reaction. What I do is I'm looking at the candle close and the distance from the high for a bullish candle. With a bearish candle, I'm looking at the candle close, but the distance from the candle low. That is called the wick. So if the candle close, for instance, on the euro dollar, right, is 117, and the high is 117.20. All right. The wick. What is the wick in this case? I'll leave that. I'll ask you. What do you think is the wick? How big is the wick? If the candle close is 117 and the candle high is 117.20, it's not very relevant, but let's say the candle open is 116.50 and the candle low is 116.46. All right, so the total wick measured from close to high is what in this case? Do you know? Okay, no quick answer, so it doesn't matter. It's 20 pips because it's the difference between 117.20 and 117.00, which is 20 pips, right? Because it's the high minus the close. Okay, so maybe one more example. A candle close of 135, or let's take a bearish example. 135 bearish close, 135.20, and the low is 135.34. What is the bearish wick? What is the size of the bearish wick in this case? Yes, exactly. Indeed. Great job, Andre. It is 14 indeed. 34 minus 20 for the bearish example. 14 pips. So now that we know the wick, we need to know the total candle size. All right, so we're talking about not the body, but the total candle size, which is the high minus the low. The body would be the close minus the open, or the open minus the close, depending on if it's bearish or bullish, right? So the candle size, high minus low, and that's something that Steve Neeson tonight, he's going to talk more about candles, by the way. So if you like candles, candlesticks, Japanese candlesticks, tune in tonight or watch the recording. But candle size is the high minus the low. So the next step is then to measure the wick, or take the wick size and divide it by, the wick divided by the size, the candle size. So in this case, if we had a wick of 14 pips, right, and the size of the candle was 140, guess what? The wick is 10%. So we know now the wick percentage. What percentage of wick, of that candle? What is how much of that candle consists of wick, if you see what I mean? So one more example, and I'll let you answer that one. All right, so just to check if everyone's on board. But basically, if there's a wick with, let's say, 20 pips, as we originally were talking about, but the candle size is, let's say, in the first example was about 80 pips, right? So 20 divided by 80, well, that's just a mathematical question. So I will not, it's not so important actually. It's 25%, right? 25% of that is wick. So what do you do with that info? That's more important. We get a percentage. So the lower the percentage, basically, the more likely that the bulls or bears are in control, basically, right? If there's no wick, that means that the bulls or bears are fully in control. If there's a big wick, that means that the bulls or bears are not in control. So anything here on this end, 65 or higher, means that there's not much control of that particular direction. What does that mean? Well, if there is control, that means that a breakout is more likely. And if there's no control, that indicates either indecision or that a bounce is more likely. So anything between 0 and 5% is, I call it perfect, but maybe not a good word, but basically that's a strong candle that indicates likely breakout. 5 to 10% is excellent. Here again, strong candle close, either bearish or bullish. That indicates a breakout potential too, most likely. 10 to 20 is already getting, of course, the wick is getting bigger, but still nothing to be very concerned about. It's still a very good breakout candle, generally speaking, and nothing too concerning for a reaction at that support or resistance. 20 to 25 is good. 25 to 30 is okay, but here it's already getting into more grayish territory. Between 25 and 35, the wick is already so big that the breakout is not looking as good, and it might be questionable. Could still be good, could still be a tradable breakout, but definitely the wick is a little bit worrying. And if it's anything between 35 and 65, that is less interesting. And 65 or more, definitely not looking like a breakout, rather more like a reversal perhaps, or a bounce. Now, these percentages are just guidelines, are just ideas, rough indications, and there could be, of course, examples where the opposite happens. But generally speaking, it's the guideline that I use to measure breakout or bounces, and I basically measure the reaction of the candlestick at support resistance levels using this kind of guide. So if you feel free to pause it if you're looking at the video later on. Now we're going to move over to take a look at some examples and how we can trade those examples, right? So yes, so good question. Just to indeed confirm and verify, Andre is saying like the wick and the size, right? The wick size relationship or the wick percentage is not important for every candle, and that is true indeed. It is. Generally speaking, we can always use that info, especially if you're looking at a daily candle whether we're at the support or resistance or not. On a daily or weekly candle, that is always kind of good info. But with lower time frames, and generally speaking, the wick percentage has the most value when price is at support or resistance, decision zone, or POC zone. Andre is asking about the euro dollar right now, when price waiting to break below or bounce. So let's take a look at that. So was anyone here in Monday's webinar about the German elections by any chance? Flavius is talking about the dollar yen yesterday. We can take a look. So anyone who was in Monday's webinar, my trade plan was to wait for Monday's candle to close near the low. In my view, that would indicate the breakout of this trend line. Now, the trend line break, as we know, is not everything. There's also horizontal levels to think about, which is right here. Right. So, but my trade plan was to say, okay, if the candle closes near the low, then there's going to be probably a breakout that the trend line has already broken, and there'll probably be a break of this support. Although there's a confluence of support, I expect the breakout and not the bounce if the candlestick close would be near the low. So that was my first step. Candle close near the low on Monday. Pre-fact, right? Anyone in that webinar might remember, right? Hopefully. And my trade plan then was to trade the bear flag 1 hour chart, zoom into the hourly chart, wait for a pattern that shouldn't go above, that should stop at 118.30, 118.70, but not above 119. It stopped at 118.60. It broke the bear flag, and I was targeting 117.50. Why 117.50? Because that's a psychological kind of quarter level, right? So, and that's where price indeed bounced off, as you can see. So, about 80 to 100 pips there, depending on where the entry is made, based off of that, breakout basically. So that's one example of a euro dollar this week. Now, at this moment, we could consider 117 to be potential zone 2 because there's a fib. I won't go through the hassle of drawing it, but there's a 117 could be a Fibonacci level. We have some bottoms here too. You have an S3. We have a Keltner. So generally speaking, 116.75, 117 could be a support zone, right? Could be a turning spot. So indeed, we can measure these daily candles and see, is the breakout, is the price continuing lower, or is there going to be potentially some bounce? So yesterday's wick, if we measure that quickly, the difference between high and low is 78 pips, and the close is 27 pips off of the low. So 27 divided by 78, we need a calculator quickly. It doesn't seem to be popping up. 1 second. 34.6%. So this wick, although it doesn't look like it, right? But if you really measure it carefully, it's a 34.6% wick. All right. So that's not really a great breakout candle. Is it a reversal signal? No, that's not either. It's more of an indecision signal, really. Price is hesitating. It's hesitating with breaking or bouncing, and even the day before it was hesitating a bit, but still managed to continue lower. So generally speaking, as I indicated in my webinar yesterday, is that I would be looking for bullish candlestick reactions here. Some bullish engulfing twins to indicate that, hey, price is stopping at 117, targeting probably the weekly pivot point up in here, something like that with the trend line. There's a confluence of resistance around that spot there. All right, but yesterday's signal, yesterday's wick was not enough. That was still a bearish candle. So it's not enough to trade it to the upside based on that, in my view, but not enough to trade it, to continue trading it either to the downside. And at this moment, I would be waiting for a bounce at the confluence. So I'm waiting for, at this point on the euro dollar, to show a bullish candlestick pattern. But I wouldn't mind a bearish candlestick pattern either. So let me explain. Now the calculator pops up. Okay. I wouldn't mind because the 38.2 fib is at 115 round level. So if price, for whatever reason, goes sideways like this a bit, or even immediately shows a bearish candle like this that punches through 117, I would be looking for a bit of retracement of that daily candle, and I wouldn't mind taking a short down to 115 either. So this is one of those cases where really I don't mind trading it either way, up or down, depending on how, as long as price shows me with candlestick patterns at the decision zone, which is 117, how it will respond, what choice will it make. And this is something, and I'll take a look at the dollar yen, which Flavius is referring to. This is something that is basically, I refer to it or compare it to dancing quite often, right? There's the lead dancer and the follower, right? The person that follows the lead dancer, right? So you have the same with the market. Price is leading. We traders should follow the direction it wants to go as best as we can with the information we have now and as the trade goes along. So I think by following candlestick reactions and candlesticks themselves and candlestick patterns, we're listening to the market as best as we can. Those purple lines are indeed drawn by myself. They indicate basically bottoms here and bottoms here. So they are manually drawn indeed, and static support levels in this case. Let's take a look at the dollar yen. Let me refresh this template as well. All right. Let's see, dollar yen yesterday. Yes, so there's a wick of, indeed, Flavius is saying 40%, and the high and the low is 104 pips. The close is about 45 pips away from the high. So it's a 45%, no, it's a 40% indeed, because yes, 40% indeed. So 43, I just calculated to be precise. So yes, more than 35, definitely indecision. So what that tells me is that it's not really, it's not breaking. It's not a strong, I would not say it's a strong reversal signal either. It's really indecision in my view. It is breaking a bull flag, excuse me. I tend to always switch those two, I don't know why, but bull flag. And yeah, we had a breakout. The breakout candle is struggling. It couldn't close above the R1 or break above the R1. It couldn't break above the Keltner, and there's a big 43% wick, and that's indicating reversal. Indecision. Now, if it were to have closed, let's say the same candle, right? Same candle yesterday, but the close would have been all the way down here, like this. Okay, what does that tell you? The wick, let's say the wick in this case is 80% wick. What would that indicate to you? What do you think that would indicate? That's a question to you. That's really to you. And we'll wait for your answer. What type of pattern? Flavius is indicating the pattern. That's great. And what kind of consequence would that have? Is it a bullish, bearish, bounce, breakout? So Marius is saying reversal. Flavius is saying shooting start. Anyone else still want to join? Just a few seconds still here. Anyone want to comment? Yes, indeed. So it's a reversal, and it's indicating a high chance that price will reverse from this position, right? These candlestick patterns, of course, do have a little bit more value, I think, on higher time frames. When we're looking at lower time frames, I'm not saying that candlesticks are not useful, they are, but I think it's better to use it as a confluence tool, as an extra supportive kind of material. So this is how we can use this info to trade bounces and breaks in a way. Now we looked at a couple of indecision candles. So maybe not the best of examples. Let me try to find something else that can give you an idea. How about here at the bottom? Just very quickly, right? Indecision wick, not enough to trade the reversal, but the next candle, very bullish, right? Bouncing off the Admiral Keltner. Let's say there were other reasons. Let's forget the analysis for the moment. Let's say that we were looking to trade long and looking for a bounce. All right. What do we see? We see a wick. That's not enough, but this bullish candle is. Look at that bullish candle because look at the close. I'll give you the percentage right now. All right. So the high and the low difference is 137 pips, and the close is 13 pips away. So 13 divided by 137 is 9.5%. So from our table here, we know that 9.5% is excellent. So let's go back to our chart. So this is excellent. So it's excellent, either it's excellent bounce, or you could even say an excellent break, because if you put a trend line like this, connecting the highs, is breaking above that. So excellent break slash bounce. And that could have been the entry. So how to trade it? That could be the entry right there upon the daily candle close. We're looking at daily charts only. It's not to say that that's the only time frame. Just by coincidence, we're looking at this. Stop loss could be, for instance, below the daily candle low, and the target could be that's something of a different story again. But maybe previous resistance. Let's zoom out a little bit, and let's say, okay, we'll aim for these tops in here, for instance, to aim for a bit of conservative target. It's a 1-to-1. But it's a conservative target. If you're more aggressive, you might say, okay, I aim for the bigger resistance up in here, for instance, right? Or you can put a fib from here to here and say, okay, I'll aim for the 61.8 or even the 78.6 fib. Right? But that would have been the entry and stop loss. If you have a strong candle, you can use the low or the high for stop loss. If you have a strong breakout like this, if the candle is not so large in size, we can use the bottom itself. And Flavia is asking, is adding that there was a gap too, so extra reason indeed. So that's an example of a trade. Let's take a look at one more in this dollar yen, and then these are range trades, but take a look at this. Where is it? Here. Oh, sorry. Take a look at this scenario, right? This one. Price is at resistance, price is at Keltner, shows a bearish close, not a bullish close, and look at the wick on top. So let's take a look at that wick. It's indicating weakness. It's indicating a bounce. The total candle size is 118 pips. The close is 23 pips off the low. Sorry, the other way around. Well, you can actually measure both wicks in this case if you wanted to, but actually I wanted to measure the opposite wick. 1 second. The close is 55 pips off the high. So 55 divided by, let's see, 29. 1 second. $78 pips, and it is 55. 70% wick on top. 70% wick on top. So that's a great bounce spot. And the close near the low, not that that's that important, but it could be even extra reason, is 23 pips away. 29%. So 29% wick here, which is an okay close for bears, and a horrible close for the bulls because they have a 70% wick on top. So that's a pretty good reversal candlestick pattern. Let's take a look at a breakout example on a trending pair, perhaps, like, I don't know, which one do you have a particular preference for a pair? We already looked at the euro dollar, so maybe the pound. All right. So for instance, down here, price going sideways like this, pound dollar in uptrend, right? Generally speaking, you can see here higher highs, higher lows. This is maybe a bounce, a correction for more upside. So as price breaks above this pattern, above this resistance, we see a breakout candle. Let's measure that breakout candle right here. And the high and low difference is 136 pips. The close is 10 pips off. So that's a pretty simple one, isn't it? 10 divided by 136 is a 7.4% wick on top. Nothing, right? Good breakout candle. So how to enter that candle? There are two different ways, or a couple of different ways. One could be just the candle close. That's the less risky in a way, right away at entry. Stop loss below the candle low because it's a good breakout candle in my view. So, and targeting, well, there are a lot of targets probably that are possible on this one, right? Other one could be is to wait for retracement of the candle, halfway to the 38.2 fib, maybe even deeper. But in this case, you would have missed the trade. That's not always the case. Here we had a pretty good candle too, and we did get a retracement all the way to the low, in fact, maybe pushing a little bit below it. Right here we had a good candle too. We did get a retracement about halfway. Here we didn't get a retracement. So whether we get that retracement depends. We don't know. We might have to look at different factors to understand whether we get the retracement or not. Look at lower time frames, look at the context, and to see if there is a potential there of price making a retracement or just immediately pushing and pulling away. So that depends. But basically, an entry, at the candle close or the retracement are kind of the two main options. Or there's a third one, in fact, which is the break of the candle high in this case, kind of confirming the breakout. That's another option, by the way. It's 27th of March. Flavius is asking about the pound dollar 27th of March, and then we'll wrap it up for today. Unless you have any questions, of course, feel free to let me know. By the way, at elitecurrency.com, the website that Nenad and I run together, basically we had a great kind of guide on the support and resistance calculations. So if you want to review it or take a look at that, feel free to do so. We had recently on our blog, free education analysis part, you will see just maybe the second or third page, I think, max fourth probably. You will find more info on that. So that's if you're interested in that, you can check it out. But regarding the 27th of March, there we go, this candle. So we see a wick. So the high and the low difference is, let's see, 127-ish pips. And the close is about 56 pips off. Now I forgot, one second, I forgot my own measurements. 1 second, I have to calculate again. So close indeed about 50, 58 actually. 50, 43, yeah, 58, and the high and the low difference is 127. $126. So 44% wick, right? So, it might be even tradable to the downside, right? But the only thing what I wanted to explain about the percentages is that the wick itself is indecision. So basically, this alone would not be enough for me to trade. I would like to see some other things, some other reasons why I would want to trade it. Maybe on the lower time frame, there's double divergence between these tops. Then it's a different story already. That would aid and support taking a short based off this wick. But for instance, we saw that great dollar yen wick like this here, right? This doesn't need that much confluence. This bull run, right, plus this wick and this candle at Keltner is enough to take that trade. just based on that wick. The pound dollar wick is not that good as that dollar yen reversal setup, but it's still could be good enough if there are other supportive reasons to think about short in this zone. But definitely the breakout is not looking good. It's indecision, and just based on this, I would do nothing. If there are other supportive factors, it might be worth a short, but there has to be extra reasons, right? But the wick is definitely big and did show indeed how price is making after that a lengthy indecision pattern. And that indecision pattern is actually turned out to be a bull flag chart pattern, all right, in retrospect. And that's something we can then again use to trade, of course, to our advantage to the upside. And you can see a breakout candle right here. Now that candle is not that big, which is a slight disadvantage, but the close is right up at the high, literally 3 pips away. The total high-low close is 92 pips. So 3 divided by 9.92 is about 3%, which is a perfect candle close in that regard. And indeed, we got a great breakout to the upside. So all of these candle closes give you, as you can see, tons of information. And Flavius has one more dating back to the 14th of March that he would like to take a look at. Let's take a look at this wick. And basically the high and low difference seems to be 112 pips. The close is 46 pips off. So 46 divided by 112 is 41%. And in a decision breakout, basically, the next one was a bullish one, and we got the bullish breakout. Or bounce, right? It's both, in a way. It's breaking this resistance, and it's breaking, and it's bouncing at Keltner. So I hope that this helped you in understanding supportive resistance, how to find it, but also how to trade it. And I hope that this can help your trading overall. If you're interested in more webinars, of course, feel free to check out admirmarkets.com. There you can find out how to trade, what platform to download. You'll find analytics. You'll find more webinars, more education, more tools. So there's a lot of things to check out there. In fact, definitely do that. And wish you all great trading and hope to see you next week with our new webinars. Cheers.